A six-figure salary is often the fastest road to personal bankruptcy. While a high income provides the appearance of success, the data suggests that many high earners are merely one missed paycheck away from a total financial collapse because they prioritize looking rich over being wealthy. The distinction between being rich and being wealthy is more than just semantics. It is the fundamental difference between owning assets that pay for a lifestyle and working a job to pay for liabilities. This analysis explores why the pursuit of status symbols effectively traps the middle class in a cycle of perpetual debt. By examining the spending habits of the top 1% versus the high-earning middle class, clear patterns emerge regarding asset allocation and long-term security. Understanding these mathematical realities reveals the blueprint for building a net worth that lasts for generations, rather than just a weekend of high-end consumption. In the world of personal finance, the term Henry describes individuals who are high earners, not rich yet. This demographic often brings in between $250,000 and $500,000 annually, yet they frequently report having less than $20,000 in liquid savings due to extreme lifestyle inflation. Being rich is defined by a high flow of cash coming in, which is often tied directly to the number of hours worked or a high-pressure corporate position. If that income stream is interrupted by a market downturn or a health crisis, the rich individual's lifestyle collapses almost instantly because they lack a foundation of income-producing assets. True wealth, conversely, is measured in time rather than dollars. It is the ability to maintain one's standard of living indefinitely without the need for active employment. Wealth is found in the brokerage accounts, real estate holdings, and private businesses that generate revenue while the owner is asleep. A 2023 survey found that nearly 60% of individuals earning over $100,000 a year are living paycheck to paycheck. This occurs because every increase in salary is met with a corresponding increase in fixed costs, such as a larger mortgage, a premium car lease, and expensive club memberships. When income increases, but the net worth remains stagnant, the individual is effectively running on a financial treadmill. They must work harder and longer just to maintain a stationary position, as their outgoing expenses consume nearly every dollar of their post-tax earnings. The data suggests that the pressure to maintain a certain image within high-income professional circles creates a psychological trap. But here is where it gets interesting. The most visible signs of wealth are often the very things preventing its actual accumulation. The primary enemy of wealth for the aspiring rich is the rapid depreciation of luxury goods. A new $70,000 luxury SUV typically loses 20% of its value the moment it is driven off the lot, and up to 60% of its value within the first 5 years of ownership. When an individual finances such a vehicle, they are not only losing money on the asset's value, but also paying interest on a declining balance. This creates a double-loss scenario where the consumer pays $80,000 over time for an asset that may only be worth $25,000 at the end of the term. The opportunity cost of these purchases is staggering when calculated over a 20-year horizon. If a $1,000 monthly car payment were instead redirected into a diversified index fund with a historical average return of 7%, the total value would exceed $500,000 in 2 decades. Wealthy individuals often view purchases through the lens of maintenance and carry costs rather than just the initial price tag. A luxury home or a high-end European sedan requires specialized service and high insurance premiums that act as a constant drain on investable capital. The Internal Revenue Service reports that the average millionaire drives a vehicle that is several years old and avoids high-interest consumer debt. This group understands that an asset is something that puts money into a pocket, while a liability is something that takes money out. By avoiding the trap of depreciating assets, an investor allows their capital to work for them rather than for the bank. The data tells a different story about why the middle class struggles. It is not a lack of income, but a misallocation of it into things that lose value. Economists use the term conspicuous consumption to describe the purchase of goods primarily to display social status. Interestingly, studies show that lower middle-class households often spend a higher percentage of their income on visible luxury logos than the ultra-wealthy do, as they attempt to signal a higher economic standing. True wealth is frequently invisible, a concept often referred to as stealth wealth. Many individuals with a net worth exceeding $5 million live in unassuming neighborhoods, wear unbranded clothing, and prioritize privacy over public recognition to avoid the tax of social expectations. The hidden cost of living in an affluent neighborhood is not just the mortgage, but the social pressure to keep up with neighbors. This includes private school tuitions that can exceed $30,000 per child and the expectation of hosting lavish events, all of which deplete the capital needed for real investment. Research into the millionaire next door phenotype reveals that the majority of first-generation wealth is built by people who are frugal and disciplined. They ignore the hedonic treadmill, the tendency for humans to return to a baseline level of happiness despite major positive changes in fortune or income. When status is the primary driver of spending, the consumer loses their most valuable asset, their autonomy. Each purchase designed to impress others effectively chains the individual to their job, as the high cost of maintaining that image leaves no room for career risks or early retirement. Choosing to look average while being financially elite is a hallmark of the sophisticated investor. But here's the key. Shifting the focus from social signaling to mathematical growth is the only way to achieve true independence. The mathematics of wealth building rely on the efficient use of tax-advantaged accounts and the power of compounding. By maximizing contributions to 401ks, IRAs, and health savings accounts, an investor can shield thousands of dollars from the IRS, allowing that capital to grow unimpeded for decades. A disciplined investor focusing on a low-cost, diversified portfolio can see their wealth double every 7 to 10 years based on the rule of 72. At an 8% annual return, an initial $100,000 investment grows to nearly $470,000 in 20 years without any additional contributions. Wealthy individuals also differentiate between good debt and bad debt. While consumer debt at 15% interest is a wealth killer, using a low-interest mortgage to acquire a cash-flowing rental property can leverage small amounts of capital into significant long-term equity. The 25 times rule is a common benchmark used to determine financial independence. It suggests that once an individual has saved 25 times their annual expenses in invested assets, they can safely withdraw 4% per year to cover their costs forever. Focusing on the net worth statement rather than the bank balance allows for a clearer picture of financial health. This involves tracking all assets, such as home equity, stocks, and business interests, against all liabilities like loans and mortgages to ensure the gap is widening every year. Ultimately, the goal of wealth is to provide a margin of safety and the freedom of choice. The data shows that the most successful people aren't those with the newest cars, but those with the most robust balance sheets. Real wealth is built in the silence of automated investments and the discipline of living below one's means, while looking rich is often just a loud mask for financial insecurity. If this breakdown changed how you think about net worth, the next video explores the specific tax strategies the 1% use to keep their capital growing.